Byte Finance, the world of financial freedom.
Hello, it's Monday, 13th day of March. It is a time to start the market forecast, in which we will discuss the most important events from the calendar and summarize fundamentals for gold and try to make a trading plan for XAU USD. Okay, so today, as usual, slow start. Nothing major happens. That is why we move on straight to Tuesday, where we will get labor data from the UK, CPI from the US, which will be very interesting to see how the inflation is currently behaving, which will be one out of two most important events of this week. On Wednesday, we will have retail sales from the US, inflation on producers' side from the US, and crude oil inventories. On Thursday, we will have the ECB rate decision, which most likely will be a change to the upside by 50 basis points, as the consensus suggests. And this is the second most important event. On Friday, we will have a final CPI reading from the Eurozone, so unless we will see some bigger deviation from the preliminary reading, we shouldn't see much of a movement during the publication of this figure. Okay, now let's switch to some fundamental factors for gold, which is searching for its place in the sun and believes the US employment report for February will help it. Meanwhile, the US stock market continues to think that inflation will slow down by itself and that the Fed will manage to ensure a soft landing. The bond market, on the contrary, is sure a recession can be avoided. Thus, gold believes the truth is somewhere in between. The asset is choosing between a higher federal funds rate and a dovish return somewhere between September 2023 and March 2024 and keeps staying above $1,800. Gold seems stuck between the past and the future. In January, the predominating idea was that US inflation would slow down as fast as in the second half of 2022. So, the funds rate was supposed to reach only 4.9% and start dropping by the end of 2023. The US economic state would continue worsening, even if a soft landing could still be possible. The return of the global supply pressure index to its pre-pandemic levels supported this scenario. Supply outages were some of key drivers in the price growth. Having handled them would allow inflation to slow down by itself. However, US stats in February were so optimistic that the Fed had to mention a rise in borrowing costs and a higher monetary restriction pace. The derivatives raised the ceiling for the federal funds rate to 5.5% and the market narrative shifted. Investors now believe the Fed will resume its aggressive monetary restrictions and provoke a recession. The bond market believes it more than anyone else, as two-year bond rates soared to the highest since 2007, and the yield curve collapsed to the deepest throw since 1981. Stock markets don't even know how to react to the US strong statistics since the beginning of the year. Only gold behaves smartly. It admits it knows nothing. That could explain why it fluctuates from the levels of 1,805 to 1,850 and backward. Still, some believe the latest surge in XAUUSD prices was due to Singapore's building up gold holdings from 4.9 million to 6.4 million ounces in January, a 30% increase roughly. However, I think gold is reacting to the macroeconomic environment more than to the state of the physical asset market. As for the future price direction, the strong payrolls didn't throw off the price below the 1800 level, nor the Powell comments shoot the price higher. Therefore, if the US CPI data on Tuesday will turn out to be hot, the price should break out of the consolidation to the upside. If the reading will be slightly lower, then I believe we will consolidate still between 1800 to 1900, because there will be no other significant factors to influence the price for that moment. And so, on that note, I'm ending the video. Thank you for watching and goodbye.